And joining me this morning to take a deeper dive into the markets and what we can expect from them is the CEO and co-founder of Key Advisors Wealth Management, Eddie Ghabour. Eddie, Happy New Year.
Happy New Year. Thank you for having me.
All right, so kind of a mixed market today. We're getting our footing here, certainly in the new year. What do you think lies ahead for markets in 2024?
So I think there's going to be lots of twists and turns this year and some buying opportunities in the first quarter. We do expect some weakness in the first quarter, but to your point, a pullback should have been expected after the nice rally we had the last 2 months of the year. And I think the reason why we will get some weakness is simply because of the fact, I think coming into the year, investors, I think, were too optimistic on the aggressiveness of rate cuts for the Fed. We don't expect them to cut rates in March. And then the inflation data, I think the last mile of inflation is going to prove to be sticky. So that's going to cause some volatility in the bond market and the stock market. And those are opportunities that we do plan to buy in this first quarter because as we get past the first quarter and start pricing in properly the rate cuts that the Fed will be doing, I think you can get some upside in the areas that really didn't participate as much as the mega cap tech last year.
Okay, so let's talk more about those buying opportunities. Eddie, obviously, you noted that you do see buying opportunities likely here in the first quarter. Walk me through what those buys are and a better sense of why.
So if we're going to have a broadening out of this rally this year, which we would expect, you're going to have other areas participate, in our opinion. So small caps and mid caps, we will be buying dips there here over this quarter. The other area that's really gotten beaten up, it's having a bad open this morning as well, too, is energy. And I think you can get some decent dividend plays there as well, too. So we have that as a target for us to be buying in the first quarter. Our strongest conviction that we actually own, we've owned for several months, is India, as we try to go abroad as well, too. And India, interestingly enough, has outperformed the NASDAQ and the SPY over the last 6 months. Their economy continues to show very, very strong strength. And again, here domestically, we'll focus on small caps, mid caps. We will go energy, and then just broad-based dividend plays. I think you're seeing some really interesting yields. So especially if you're retired or approaching retirement, you can build a strategy that generates nice cash flow to help meet income needs, but owning underlying assets that have some appreciation opportunities over the next several years. So, and then the healthcare, you brought that up earlier. You know,
right.
They're just areas that didn't do as well last year that could see some nice upside.
Let's talk more about these dividend plays, Eddie, because I think a lot of people with retirement on the horizon, or certainly in retirement right now, are thinking about what to do in this crucial time. In fact, for them, given some uncertainty that does still lie ahead in the stock market, what are those specific dividend plays where you do see upside? And on top of that, what makes them more attractive than still a high yield savings account that could get someone anywhere from 4.5% to even 5%?
Well, we're seeing some yields right now on some underlying strategies that are 5 to 8%. And look, there's nothing wrong with having some money market treasuries that are stable, paying around 5. We have that in our portfolios. But understanding that if we are going to get rate cuts, which we do expect cuts, those short-term treasuries and bond yields will come down. So as you start dollar cost averaging into an asset that could see yields going down, going into assets that yields are actually going higher. So you've got some corporate bonds right now that are paying some attractive yields. You do also, I'll pick a name like a Verizon. You have a defensive style name in a company that has good pricing power. We haven't specifically bought that name yet for clients, but their dividend yield is around 6%. There's some tobacco names that are paying 5 to 8%. And when you look at the underlying asset, they're pretty low relative to where they were. And just the dividend scope in itself has just been an underperformer. And again, I think it's a way to hedge against volatility because we are in a high debt environment for the foreseeable future. So it's not just smooth sailing, in our opinion, where you can just buy risk assets blindly and just expect them to go straight up. So these dividend yields help buffer against that volatility.
Let's talk more about the Fed, Eddie, because we do know the Fed will dictate really the path forward for stocks and where they decide to put interest rates, with 3 of those rate cuts predicted this year by the Fed at its latest meeting in mid-December. What do you anticipate that we hear from the Fed over these next few months as the data continues to come in?
So I think the Fed is going to be really patient on their first rate cut, and I don't think the market has fully priced that in, because they have made it clear in the past that one of their biggest concerns is cutting too early and having inflation reaccelerate. To us, that would be the worst case scenario. So I think they're going to be more patient, because we're going to see an environment where you're seeing economic data maybe slow, but not fast enough, and that core inflation number staying, much higher than the 2% number where they're trying to get to. So unless they change their goal and change inflation goal to 3%, I don't expect the first cut till we get, late spring, early summer. And I don't think we'll get 3 cuts unless we actually have a recession. If the economy falls off a cliff and we have a recession, they will cut more aggressively. But if we don't, I don't see why we get more. Why would they cut aggressively if there's no recession?
Year-end target on the S&P, do you expect will be higher by the end of the year? And if so, by how much?
So we do expect it to be higher. I don't want to put a year-end target yet, because we really, it's this environment, again, with the twists and turns, it's going to be about timing on when you buy. So do I think that we're going to have a higher S&P than where we are today? Yes, but in this crazy environment, to predict what it will be at the end of this year, I think would not be fair to our clients.
All right, Eddie Ghabour of Key Wealth, Key Advisors Wealth Management. Eddie, it's great to see you in the new year. Thank you.